Welcome to the Other Side of Wall Street with your host, Ron Harrison.
Good morning, everyone. Welcome to the Other Side of Wall Street. My name is Ron Harrison. I'll be your host. And as I promised in the beginning, we are going to each week continue from where we left off in the prior week. So think of each week as a new chapter in a book. And as we ended last week, we were starting to touch on the topic of trading psychology and how vastly important that is to any trader's success. I had problems with that. I'm sure you are having problems with that, even if you don't realize it. And emotions really can be found to be the root cause of pretty much any trading problem that you may have, trading losses, however you want to look at it, your lack of success, any direction you want to take that. I would almost guarantee you that almost every case, every instance of that can be traced back to your trading, your mental state, your emotions. In other words, your fear, your greed, and your ego, and what those three emotions will do to your trading decisions. It's unbelievable. And most people do not even know that's the case. They are not even aware of it. And that's because of one of those three components, the ego part, is telling you that that's not the issue. It's something else, anything else, but it's not you. And until you get past that, nothing's going to change, really. So now that let's spend today talking about psychology, market psychology, trading psychology, your psychology. And to start with, I want to point out that there are basically three major categories within that you have to be aware of and understand, and how they interact with each other. And those three categories would be the mass market psychology, which would be the workings of the entire market as a whole. Then you have the gambler mentality, which in our case, that's going to be the other side of our trades. So when we put a trade on, you have to understand who is going to take the other side of that deal and how they think and what they're thinking. That would be and I like to say, the gambler mentality. And then, of course, there are your own emotional tendencies, your own emotions, your own fear, your own greed, and your own ego. So let's start out first with the mass market psychology. I don't know how many times I have watched it, and I'm sure you have also. On certain days, markets are just going up like there's no tomorrow. I mean, just up. Massive market moves to the upside for whatever reason, and everybody's excited. The economy's doing great. Everything's good. Money's good. And then the next day, everything is down. Gloom and doom. All the talking heads on TV shows, CNBC, Bloomberg, they all come on and talk about how bad everything is and why it's falling, and all, different scenarios all pointing to the downside. Whereas just the day before, people were on there talking about how wonderful everything is and pointing everything to the upside and all the positive things that are out there. And if you notice, on days like what we're talking about here, you'll find that in many cases, the entire market is either rising or falling. So it's not like you have different sectors, like technology is doing good, but transports are doing bad, or retail is doing bad, but banking is doing good. On some of these days, many of these days, everything falls or everything rises. So think about it. Companies and the price of their stocks, price of their shares, should be based on fundamentals. What the company is doing, sales, products, new products coming out, how they're competing with their other companies in the same market, things like that. That is what should dictate the price of a share of their stock, any stock. But when entire markets fall or entire markets rise from one day to the next, you can be sure that, let's say the first day was the up day and the second day was the down day, nothing has changed inside of those companies. Nothing. They're still doing what they're doing. They still have the same sales they had the day before, same products they had the day before, same management they had the day before. But why would every company, every stock in the S&P, the Dow, whatever one you want to look at, rise one day and all of them fall the next day? And the reason is because of mass market psychology. I like to make an analogy of on days like that to where you would have a nice green pasture and a big herd of sheep, and they're all standing around munching on the grass. And all of a sudden, something runs out into the field, maybe a wolf, maybe who knows what it could be. Something runs out, spooks the herd, and they all turn and go left, and they run like crazy. And they're running like crazy and running, and all of a sudden something else jumps out in front of where they're going now. And all of a sudden the whole herd stops, turns right, and starts running the other way. And to me, that's mass market psychology. The entire market listens to the media, and the media comes out with some kind of story, and it's, oh my God, sell everything. And then the next day they find out that that story wasn't really true, or some other story comes out that maybe counters that. Oh, let's go buy everything. So to me, the market, because of the aspect of the psychological part of it, has lost all connection to fundamentals and why a company and why their shares of stock are worth what they're worth. It's totally become now a psychological herd of sheep scenario, running first one way and then the next way, the other way, and back and forth, just running away from whatever it is they're afraid of, or towards whatever it is they want to get to. And it has taken really all resemblance of to me, a stock market that I've ever seen. It has become really impossible almost for some periods of time to even trade this market, because you never know what new story is going to come out. Now, of course, lately we have another factor that's also doing the same thing, and that is a certain person in a high office that likes to tweet. And every time he tweets something good or something bad, the herd of sheep go one way or the other. And in his case, he could be tweeting 4 or 5 or 6 times a day different things, and the market is just zigzagging back and forth. I've seen days where the market has been down 300 points, and a tweet will come out, and all of a sudden those 300 points are erased, and now we're positive. Or the other way around. We could be positive, a tweet comes out, then we're down 300 points instantly. And that is, it's just no way to manage investments based on the market, the mass market psychology, and the reaction to a particular person sending out tweets. It is so ridiculous. But at the same time, that is what is happening. And you have to understand that. So I'm not telling you a way to get around that, because you can't. But you just have to understand it. So many times when you have trades on, you have to think about, okay, how ridiculous is this? Why is this market moving? And try to dig deep enough and find reassurance in what you know the fundamentals are of the current state of a particular stock, a group of stocks, an industry, or the entire market in general. But you have to not let yourself fall into this mass market psychology and start reacting based on every little piece of news that comes out one way or the other, because you have to think back and you have to look, let's say back in a month, 6 months, whatever, and think, okay, I remember it did it, such and such date, and then a couple days later it was all forgotten about, and so on. Try to think back historically that these things really didn't last and didn't matter, and just follow the fundamentals, in this case, of the economies, of the companies that you're trading. Just stick with things and don't get caught up in the mass market psychology or all the hype that the media puts out there on a daily basis to try to either excite you into buying or scare you into selling, because that is not how the market should work, and that is not why you're investing and trading in companies to begin with. You're doing that because you believe in either the economy or the company or what they're doing or the industry or whatever. So be careful there. Understand why the market is doing what it's doing. Again, the mass market psychology aspect of it. But at the same time, don't get caught up in it. That is one thing you have to be very careful of. So that's really a short explanation of mass market psychology and how and why it does what it does. And again, the importance that you do not get caught up in it. So the next piece that I want to touch on is the gambler mentality or our customer's mentality. And when I say that, I've got to kind of combine this with our own emotional tendencies, but I know I've mentioned before that one of the major techniques that we use in our trading is options. And we talked about that last week, I believe, too. And within that, we talked about how bad a reputation options have because most people lose whatever they spend buying options. The key word there was buying. And I remember I told you that if you have an instrument like options that have such a high rate of failure, and again with options, it's up in the 90% of most people that spend money buying options lose what they spend. If you have something that has that high of a level of failure on one side, the market being a zero-sum game, you have to have the equal and opposite on the other side. So if the buyer of the option has a 90% chance or 90-some% chance of losing on the trade, then the seller has to have a 90-some% chance of winning on the trade. It has to work that way, zero-sum game. So in our case, we sell. We don't buy. We're the sellers. We're selling options. So who are we selling them to? We're selling them to the people that I like to call the gamblers. I also remember last week I pointed out to you that options were originally brought into the market because the industry knew that there was another massive group of people out there with money that they were dying to spend, and those were the gamblers, the people that like to go to the racetracks, the people that like to do the horse racing, the dog racing, like to go to Vegas, like to play the games, like to play the machines. And those people want to put out a little bit of money for the hope of a big win tied to that later down the line. And it usually, as we all know, with Vegas, doesn't happen. But in our case, you have to understand how the gambler's mentality works in this industry, in the brokerage, in the world of trading and investing. We're not even investing, trading. So we're selling options. Now, without going into great detail on options themselves, that will come later in another episode, you have a lot of, let's say you want to trade an option on Microsoft, where you have a lot of choices as far as which option you either want to buy if you're on one side, or you want to sell if you're on our side. So what we do is we sell very cheap options. And the reason that they are cheap is because they have such a low likelihood of ever making any money. Almost zero chance of making money. They're basically, when we sell them, they're basically worthless. They have some time value to them between when we sell them and when they expire, but they really have no other value at all. So hence they are very cheap options. Now think about who we're selling them to. We are selling them to someone who has been labeled in my book as a gambler. So the gambler wants to come in, put down a very little bit of money, as little as possible, cross his fingers, and hope that the trade works out. He doesn't want to risk a lot of money. And if he did want to risk a lot of money, he'd be better off to buy a more expensive option, which has a much greater chance of producing profit, but that costs more. And that's not how they think. So in his case, this gambler, he wants to spend as little as possible, so he buys the options that we are selling. So we are selling very cheap, basically worthless options to the gambler who has the hope that maybe he'll somehow get lucky and it'll work. We're coming up on a break right now. Let's take a break, and then we'll be back and continue this.
Here's another look into the world of trading.
Tired of losing money in the markets? Ever feel your trading is nothing more than gambling? Well, if you looked at gambling from a different perspective, you'd realize that there is one side that wins almost every time, and that's the house. Well, your trading should be no different. We are the other side of Wall Street, and we are former Wall Street traders. And while on Wall Street, the most important lesson that we learned is how the brokerage houses traded their own money as opposed to how they recommended their clients trade their money. In essence, they made sure they were the house and their clients were the gamblers. So we started the other side of Wall Street to teach people how to stop being gamblers and start being the house. So let us teach you how to give yourself that same 80 to 90% chance of winning on every trade you make while your account remains mostly in cash. Be the house. Call us at 949-734-1698. And again, that's 949-734-1698. Let's make some money. Welcome back, everyone, the other side of Wall Street, and we are talking about trading psychology, and more specifically at this point we're talking about the gambler's trading psychology. In other words, our customers, the people that we would sell our positions to. So you want to look at it. A gambler's psychology is gamblers rely on hope, cross their fingers and hope the trade goes up, hope it works out for them. Gamblers want to pay less in the hopes of getting more. They're cheap. They don't want to pay a lot. As little as possible. That's what they're after. So they buy cheap options, which is what we sell. I said before, basically worthless options that only move pennies for every dollar that the underlying moves. In other words, say it's S&P or SPX, which is what we sell. The S&P could move $10, and their option may only move a few pennies. Not a big move for what they're putting down. The gambler hopes that the underlying has a massive directional move, which is something you, in most cases, would not be based on any kind of historical analysis. They just hope. Again, gambling. Just like when you put the money in the slot machine, pull the lever, and hope all the cherries line up. That's exactly what they're doing. So who are those gamblers? It's the retail customers of the brokerage houses, the day traders, and the option buyers. That is our customers. That is the gamblers. And it's basically the way this works is winning traders make money by exploiting the consistently irrational behavioral patterns of other traders, or in this case, the gamblers. So it's your job to understand how they think, how they work, not just the gamblers, but also the mass market, which you talked about prior. Understand how both of those components work so that you can exploit that against them and profit, which is what we do. So it's really not that bad. And people keep saying, well, are they always going to be there? Or, of course they're always going to be there. They're not going anywhere. Gamblers fall prey to the lure of the get quick rich opportunity. Or get rich quick opportunity. Dyslexic. They rarely convert to any kind of systems. They don't want to spend time learning any kind of trading system. They don't have the dedication to do it. They just want something quick, easy, and cheap. Again, gambling. Just think of Vegas. So once you understand how they work, it becomes a no-brainer as far as how to play the game. And you're always going to have gamblers in your world, and they have a hard time hearing about anyone's success. So a gambler doesn't want to talk to anyone who's actually doing the hard work and trading the correct way. They want to be in quick, cheap, and out, and they think they're going to win, and it doesn't. So again, they're never going to go away. They're always going to be there, so we're always going to have a market for our trades. And as long as you understand how their minds work, you should be able to structure your trades so that you profit off of them. So from that, now we can look at our own psychology, which is something altogether far bigger to understand, far bigger to control, and it's never going to go away. What I like to tell people is that when you're in this world, this trading world, to where you're risking your own money, day after day, and you always have your three friends, which I'm saying that sarcastically because they're not your friends, your fear, your greed, and your ego, sitting on your shoulder, constantly trying to get you to do all the things you shouldn't be doing. It becomes a very difficult task, even though people don't realize it. People tend to think that trading, when they first start it, should be easy because they see all the people, they listen to CNBC or Bloomberg, and they see the successful traders on there talking about, how well they did here or there or whatever. Well, the thing is that those handful of successful traders that constantly keep showing up on these shows happen to be traders that over the years, and I guarantee it wasn't in the beginning, but over the years have learned how to conquer and control their emotions. So they are able to trade very methodically, very systematically, without the interference of emotions. And they've mastered that. But most people do not trade that way. Most people cannot master their emotions. And what I like to tell people as an analogy is, imagine that you are an alcoholic and you happen to work as a bartender in a bar. Think of how difficult that's going to be, because you have to on one hand, you have to master the problem that you have being an alcoholic and not drinking. At the same time, you're working behind the bar where all the alcohol is and you just want to drink it. So you're never not going to have emotions. They're always going to be present. And as you're trading, they're always going to want to interfere with what you're doing and cause you to do things that you shouldn't be doing that will ultimately result in you losing money. So it's a never-ending battle. They're never going to go away. But for those people who are aware of those and can take the right and proper steps to control the emotions, have a very good chance of being a very successful trader, which is what these professionals that you see on TV and radio and read about, whatever, they have managed, and they have done that. They have managed to control their emotions. So as you're going through this journey, you have to be aware of why things are going wrong, why you're doing the things you're doing, and go back and try to analyze what you did in that trade. So that's always a good reason why every trader should keep a trading log. Why you got in the trade, why you got out of the trade, what went wrong, where the market was at the time. Keep track of all the statistics surrounding the trade that you just placed. So if it does go bad, you can go back and look at some things afterwards and try to analyze what went wrong. If you don't do that, if you just place a trade, play it out, let it go bad if it goes bad, and then look on to the next one without any kind of documentation or any kind of trading log, I promise you that once again, your one friend, Mr. Ego, will tell you that you didn't do a single thing wrong. Don't worry about it. Let's just find something else and go on. Because ego will want to tell you that you are perfect and you are very smart and you don't make mistakes and that you don't do things wrong. And that's not the case, because the other two guys, fear and greed, were causing you to do things wrong all along. So these things work together. So I can go on stories forever about how people I've seen that have made trades that were affected by both fear and greed and caused them to do the absolute most stupid things in their trading that caused them to lose quite a bit of money. And to me, if they had gone back and looked at those, their reaction should have been, why in the world did I do that, or whatever. And again, when you look at it, when they go back and look at it from that perspective, they're thinking clearly at that point, and they look back at what they did in the trade, and of course, what they did in that trade was a direct result of either fear or greed or both, which was causing them to do some really weird things. But now that their head is clearer, they look back and they say, why in the world did I do that? That was so stupid. And maybe next week we'll go into some more details of all the possibilities of what your own emotions can do to your trading. But one of the big things is risk management. And that is something that really is the downfall of most traders. And stop losses, it's one big thing. Most traders don't tend to do those correctly. or when they do put a stop loss in an order, they put a stop loss somewhere where they feel comfortable that that's as much as they want to tolerate. And that's not always the correct place to place a stop, because again, in future episodes, we're going to get into technical analysis, and you'll learn that by looking at a chart, you can tell what's at what price that your thought about what this thing was going to do is wrong. So you get in a trade, let's say you go long, you buy the stock, where must you say I was wrong? And based on the chart, that's a certain place. And if you just put your stop somewhere where you feel comfortable putting it, you very easily could have that particular stock or the market, if you're doing SPX, retrace a little bit, just a slight correction, and then continue on in the direction you thought it was going to go to begin with. But because you put your stop too close, then you might have gotten taken out and still have been right, but you took a loss, and then the trade went on, and now you feel like you shouldn't be trading anymore, or whatever. Now other emotions come into play. So we can cover a lot more in that area in the next episode. But right now, I'd like to point out just how difficult controlling, monitoring this emotional problem that I think everybody has on your own. It's very impossible to sit down and figure this out without some kind of support or help. And that's why we like to invite you to join our trading tribe, where you would actually each month you'd have at least 4.5 hours of coaching, 4 of those being group, a half hour of that being private. And that is really a very, very good way to shortcut this whole process and get your emotions under control so that your trading can be improved. Everyone needs something like that, whether you realize it or not. Trying to do it on your own is nearly impossible because of the 3 emotions working within each other, back and forth, off each other. It becomes a very, very, very difficult thing to do. You need a support. Just like, I spoke earlier about an alcoholic working in a bar. Well, if you're an alcoholic, why do alcoholics go to the meetings every week? Because of support. You need a support team. You can't do this on your own. So I very strongly urge you to, hopefully with us, but there are other people out there, but you need a mentor. You need someone to analyze what you're doing and point out possibilities of what you're doing wrong. And also, if you're with other people doing the same thing, you become like I say, just like with the alcoholics, you end up being a support team for one another. And that tends to work very well. And that is an excellent way of getting your trading back on track and becoming the professional that you've, that inspired you to get into this to begin with. So I encourage you, go to our website, which is theothersideofwallstreet.org. There you can read about our trading tribe, all the things that are included with that. You can look at some of our courses, another good way of fast-tracking this whole process, because we do spend a great deal of time in our classes talking about trading psychology. And again, it doesn't matter what system you use, technical system, as far as trading, whether you're a day trader or long-term trader, whether you're doing options, whether you're doing stocks. It doesn't really matter what you're doing. It doesn't matter if you're taking our classes and using that system, if you're taking someone else's classes and using their system. I promise you, whatever system that you're using, your emotions can and most likely will make it fail. And of course, I like to call it the trading method shuffle, because most people will try one method, it doesn't work, they blame it on he doesn't know what he's talking about or whatever. Go on to the next system, try that for a while, it fails, blame that person. Go on to the next system, try that for a while, it fails. So think about it. If no matter what system these people try and they all fail, what's the only common denominator between all of those systems? And that is you, the person using those systems. You are the flaw, and I don't mean that as you and as a whole, but your emotions is what's causing all of those to fail. And you may be able to get through life just fine with those same emotions on a day-to-day basis. But when you risk your own money trading, it doesn't work. So again, we're getting close to the end here. I encourage you to go to our website, theothersideofwallstreet.org. Check out what we offer. I strongly urge you to join our trading tribe and start getting the kind of support you should be having. And this isn't something you have to do forever, but just until you get your emotions under control. I've been through this before. I've helped other people do it, and I know what can go wrong if it's left unchecked. And I know how successful you can be if done properly. And it's not impossible with the right help. So again, you would get at least 4.5 hours of private or semi-private and private coaching each month, which is quite a bit, actually. And we could really turn some things around and get your trading back on track. Otherwise, I encourage you to read my blog every week. That's also found, you can find that on the website. The last 2 that I've done have been totally centered around trading psychology, going into a little more detail than what we're doing here on the half-hour show. So check that out. And otherwise, I hope this was helpful today. And with that said, I want to wish everybody thank you for showing up, and we'll be back next week and continue this. Thank you. Goodbye.